Difference between paper gold and physical gold. In the West, ETFs are bleeding because weak hands are selling shares. In China, the central bank is buying. And if you look at the numbers that have come in from China, so we're supposed to believe that silver is worthless, right? Because the price is getting hammered, the greatest tool of misdirection, price. Here's the customs data from Bloomberg, okay? Bloomberg reporting about Chinese customs data. 790 tons of silver imported in the first 2 months of 2026. February alone was 470 tons, the highest monthly import volume ever recorded. As metal is dumping here. And to me, what it signals is that lower prices are not weakness, they're opportunity. This is accumulation, this is positioning. And remember, there's a buyer for every seller. And the buyers of this panic are the smart money traders. The people that know the fundamentals haven't changed. And this is only a normal sentiment reset to build the next fuel for the leg up. So far in the month of March, we've seen 12,532 gold contracts delivered and 8,713 silver contracts delivered. So that's 1,253,200 ounces of gold delivered as the price is getting clobbered, and 8,713 silver contracts times 5,000, that's 43,565,000 ounces of silver getting delivered, literally, as the price is getting clobbered. You have JP Morgan, according to the March 20th Commitment of Traders report, that right at the bottom, at the very bottom, they closed 633 short contracts, or 3,165,000 ounces short they cover. Are the banks getting on sides? Is that what they are using this for?
Once the banks cover their shorts, the physical metal is immediately removed from the grid. Millions of ounces are being systematically loaded onto trucks and drained from the COMEX vaults. This is not routine trading. This is a permanent exit from the Western financial system.
And it is still at a relatively high number. However, 6 months ago, in September of 2025, it was at 200 million ounces in the registered category. Now it sits at 79 million ounces. Roughly 120 million ounces have been drawn down in 6 months out of the registered category. So let's put things in perspective. We look at the Shanghai Metals Exchange, same thing. It's being drawn down. On the report from March 20th, the Shanghai vaults were holding 362 tons. That's down 100 tons in a single week. 2 million ounces left the COMEX vaults on Friday. Just bye, see you later. You know, the numbers of offloads, or loadouts as they're called, where metal is leaving COMEX, is getting bigger and bigger and bigger. Once it leaves, where's it going? It's never coming back, ever coming back. And this is an important thing to think about. It's one thing to see lots of deliveries. We are seeing lots of deliveries. It's another thing to see lots of metal leave the COMEX ecosystem. It is never coming back. And this, to me, at the same time China is loading up, at the same time India is moving benchmarks away from the West. These are all things that I think are really, really important to understand. Metal leaving the ETFs, yet at the same time, the exact same amount leaving the COMEX. Is it filling a void so that it doesn't look as bad as it really is? February delivery showed that there was 38 million ounces that left in the month of February, left COMEX, right? And that shows up, you can see that, right? I wonder if there's a correlation, because what we just found out is that the ETFs lost 38 million ounces of silver, SLV did, which got thrown back into the market. Almost exactly 38 million ounces left the ETFs, right? So is there any coincidence that 38 million ounces of silver left the ETFs, but 38 million ounces of silver left COMEX? So is it the same silver? Are they moving things around, like moving the deck chairs on the Titanic? And that's just, that was over the last 3 weeks, by the way. So the timing is exactly the same. The BIS, Bank of International Settlements, came out with a report not too long ago saying, just last week or so, and saying that the collapse in the price of silver was structural, not fundamental. They said it had a lot to do with the massive influx of levered ETFs that in January needed to rebalance. Not to mention a lot of these ETFs will rebalance daily, but the big ones had to rebalance in January when the market collapsed, along with margin increases. So they jacked up margin rates by 300% between December and January, putting great strain on any of the speculators or any of those like us or the refiners that need to hedge stuff. Huge cost increase, which created selling, which begat more and more and more selling. And the rebalancing of the ETFs at the same time created a cascade, a waterfall, where the BIS said this was not fundamental, this was structural. This was done because of the rebalancing of the levered ETFs and also because of the margin increases largely. But why do I say that it's structural, not fundamental? Even the Bank of International Settlements came out and said, this is structural. This is not fundamental. It's structural in the respect that they said it is an increase in the massive amount of levered ETFs that had to reset in January. They had to rebalance because December, the president, up. They had to rebalance. And then margin increases, up. Everyone got squeezed like a grape. And they did. And so the leverage has disappeared to the point where Ed Steer, your buddy Ed Steer, great guy, is saying that it's the lowest short position that the commercial banks have ever had by a long margin in silver, ever. So could it be that they knocked the hell out of it to get on sides, to increase their long position? You know, the Economic Times said they're net long a while ago. That could be 11 long, 10 short. They're still short a lot, but net long. Well, are they getting more and more and more and more long? I would argue they are. And so, you know, I think you need to kind of look at these things with a little bit of, I don't know, you have to look at things, maybe not, you have to think outside the box. We can talk about things that are happening, again, that will massively change things. You know, India, as of, April 1st, has mandated that gold and silver ETFs switch from the London benchmark to domestic Indian exchanges as of April 1st, because it's a loss of confidence. They don't trust the Western benchmark price. Well, that's the same exact thing that we see happening, I think, around the globe, a loss of trust. And I do believe here in the U.S. that the big banks have covered a huge position, a portion of their shorts. Open interest is incredibly low. There's been a lot of silver and gold that have been leaving the exchanges. These are, I think, when you have open interest as low as it is right now, that basically means that you don't have the managed money willing to take the other side of all of these trades, these short positions that the banks are putting on. And when you have low open interest, that means that you have the ability for the price to really slingshot when demand jumps into it.
The panic to secure physical metal is even causing a massive bottleneck inside the United States. Domestic refiners are completely log-jammed by the unprecedented demand, forcing institutions to quietly export raw gold out to Switzerland just to get it refined into pure bullion.
So, look, all I can tell you is that all is not as it seems. Price is a tool of misdirection, and as the price has been hit, we're seeing so much in the way of deliveries here in the United States on COMEX, a lot of it leaving. A lot of people who think that there's a high probability. Look, on one end, you look at Jane Street, who's already being prosecuted by India, and at the same time, the other end, the co-party on this would be JP Morgan, who paid a $920 million fine for manipulating the market and has been given more or less sovereign immunity, it would seem, on a large scale, even though they had jail time for their head trader, Michael Nowak, and even though they paid that fine of $920 million, the desk made $1 billion that year. They walked away up $80 million and are still allowed to be the custodian of the world's largest silver trust. So, you know, did they really get anything other than a slap on the wrist for manipulating the market? But the theory is that They had about 40,000 shares of SLV, and then within a month, they ended up having over 20 million shares, the largest holders of SLV, the largest holder of SLV. And the theory is that they then loaded up on the other side with massive amount of options. This is what they did in India, massive amount of options that would profit if the price fell. So they become the largest holder of silver, period, SLV, rather, and then load up on options on the other side, which are harder to discern that they own them. And they profit when the price falls. So they load up on silver and then dump it as the price falls and make 10. So they lose on their shares, on the 20 million shares they own, but make many times that on the options as it goes the other way. And that is the footprint that many believe has been left in the snow, so to speak, and that this was all contrived. Now, if it was contrived, let's take the opposite side. Let's take conspiratorial side of it. If it was allowed to happen, it would have been allowed to happen to get the banks on sides. Now, could that really be how things get played? Yeah, why not? If the banks, if Trump and the administration said, you guys have had this position for far too long, the world is accumulating this stuff, we've just designated silver to be a critical mineral. The European Union did it a year and a half ago. China did it in November, saying all of their domestic production will not be sent abroad. It's for domestic consumption, and they're going to limit exports. It's time for you to get on sides, and we'll leave the banks in Europe and Canada exposed to this, but you need to get on sides. Well, how do we get on sides when silver's at $100 and we have short positions at 60 that are bleeding? Well, we're going to give you one last chance, and we're going to get Jane Street involved. Now, could that happen? I don't know. If you watched, as I've said many times, the Chris Marcus or Andrew Maguire interview with Bart Chilton. He did two of them. And at the very end, when Bart Chilton says, I went into my superiors and said, JP Morgan is in violation of our agreement and antitrust law. They need to be prosecuted. He said, I was told by my superior, which would have been Hank Paulson, the Treasury Secretary, to back down, Bart. It's a political decision. We've seen it before. We had the head of the CFTC admit this twice. First of all, if all of the metal that is supposedly coming in from Venezuela is in doré, our refiners are log jammed right now. If we send something to a refiner right now, it takes 3 to 4 months for us to get paid. And that's because of all the margin increases we saw at the beginning of the year, and it still hasn't worked its way through. The refiners literally are backed up several months. This isn't right. I said, if I had to guess, this is metal being sent to Switzerland for refining. They send it to the United States to Trafigura, who then sends it to the US, to Switzerland for refining, because it would show up exactly the same on the import-export numbers. But the media wants to make it look, and even those in the Twitter space who are thinking this must be what it is, they're painting a picture that is negative. That's all we ever see is negative print, and people not really, I think, digging deep and thinking outside the box. And I said, this has to be metal being shipped for refining. It's not being refined here. It's coming here first and then going to Switzerland. And I said, I'm going to get a lot of crap for this because no one's saying it and everyone is saying the opposite. So I get an email, and subsequently to this email, I have the entire string of text the client sent me. What I'm about to read you, she sent me the whole string of text. But she said, I get an email and it says, hi, Andy. I was watching your show with Michelle McCory the other day, and the two of you were discussing where the gold doré from Venezuela was being sent. I heard Michelle mention Trafigura as being the middleman. That kind of blew my mind because my son-in-law works at Trafigura, so I texted him. And he did verify that the gold doré is going to Switzerland to be refined, so you're right on your hypothesis. So what I'm saying is that, first of all, it's not that we're exporting gold. We're sending the gold that we're getting from Venezuela to Switzerland to be refined because our refiners are months and months backed up, jammed up. They can't put them in front because there are people who've already paid for this stuff that are waiting for their product. So they sent it to Switzerland for refining. It shows up on the import-export numbers the exact same way. You see 1,253,200 ounces of gold be delivered here in March, and 43,565,000 ounces of silver, and the week or the month isn't over yet. These are all things that people need to understand, and this is why there is an entire theory of investing called wave theory, Kondratiev wave, Elliott wave, where it measures the cumulative emotions of the herd. 2 million ounces of silver leave on Friday, just load it out. There it goes, bye-bye. But that, according to Ed Steer, 102 million ounces of silver in January and February combined, plus 26,716,000 ounces of gold so far in March, were loaded out. And we're well into the 6th year of a structural deficit. So, what are we talking about? Actually, that's delivered. Excuse me, that's delivered. I don't know exactly how much has been loaded out, but a lot. We saw 28 million ounces loaded out in February alone. So when you see all of this metal being delivered and a lot of it being loaded out, meaning leaving the system, delivered could mean just going right into the eligible category. A couple other things, and then I'll jump on any questions you have. You talk about speculation. Someone bought 11,000 December 2026 COMEX gold bull spreads between 15,000 and 20,000 after the crash, not before it. But what that basically means, there's a huge volume there. What that means is a bull spread, 15,000, 20,000 bull spread, a gold call, is that they buy 15,000. If it goes above 15,000, they win, and they sell 20,000. That spread between 15 and 20,000, they make a ton of money. This is the key point. Retail sold the panic. Large buyer used the washout to build a 1.1 million ounce tail risk position. Cost them roughly $3 million. And in other words, if it gets above 15 and gets up to 20, they win. If it gets above 15, they make a fortune, and then they sell 20. Who would do that? Who would spend $3 million thinking that by the end of December, we get to that point? And I would argue that what they are betting on is not gold. They're betting on exploding U.S. debt. They're betting on war spending, on increasing inflation, slowing growth, maybe even a recession. The energy choke point in the Straits of Hormuz, the fertilizer problems, the food pressure as a result of it, the sovereign strain that we're seeing all around the globe, and as a result, de-dollarization. In October, we just got a report that China has decreased its stockpile of U.S. treasuries to $688.7 billion, the lowest in 17 years. So the Fed's in a corner. They can't raise, they can't lower. If they lower, inflation is reignited. If they raise, the whole system breaks. And here we are, the treasury up to 4.4% on the 10-year. Bonds are being sold. So that's the Fed's nightmare.